Why growth stocks react more violently than value stocks. If you've ever watched the stock market during periods of volatility, you may have noticed a consistent pattern. Growth stocks often surge higher during rallies and fall much harder during downturns, while value stocks tend to move more slowly and steadily. This difference in behavior is not random. It reflects how these two types of stocks are valued and how investors respond to changing conditions. To understand why growth stocks react more violently than value stocks, we need to look at how expectations, valuation, and interest rates interact. Growth stocks are companies that investors believe will generate significantly higher earnings in the future. Much of their value is tied to profits that have not yet materialized. Investors buy growth stocks not for what they earn today, but for what they are expected to earn many years from now. Value stocks, by contrast, tend to generate stable cash flows today. They are often mature businesses trading at lower valuations because growth is expected to be slower. This difference in timing is crucial. Because growth stocks derive most of their value from future earnings, they are extremely sensitive to changes in expectations. When investors become more optimistic about growth, innovation, or long-term trends, the assumed future earnings of growth companies increase. This can cause large upward revisions in valuation and sharp price increases. When expectations deteriorate, the reverse happens just as quickly. Interest rates play a central role in amplifying this effect. Future earnings are discounted back to today using a discount rate. When interest rates are low, future profits are worth more in present terms. This supports higher valuations for growth stocks. When interest rates rise, future earnings are discounted more heavily. This reduces the present value of distant cash flows, disproportionately affecting growth stocks. This is why growth stocks often sell off sharply when interest rates rise. Liquidity also matters. During periods of abundant liquidity, investors are willing to take more risk and chase long-term growth opportunities. Capital flows into growth stocks, pushing prices higher. Momentum builds, reinforcing the trend. When liquidity tightens, investors become more cautious. They pull back from riskier assets, and growth stocks often experience rapid multiple compression. Value stocks, with more immediate cash flows, tend to be less affected. Growth stocks are also more exposed to narrative risk. Their valuations often depend on stories about innovation, disruption, or future market dominance. These narratives can shift quickly in response to earnings reports, regulatory changes, or macroeconomic conditions. When confidence in the story weakens, growth stock prices can collapse even if the underlying business remains viable. Value stocks are typically less dependent on narrative and more anchored by current fundamentals. Volatility is also driven by investor positioning. Growth stocks are often popular with momentum-driven investors and funds. When sentiment turns, these investors may rush to exit simultaneously, creating sharp price moves. Value stocks tend to have a more stable investor base, including income-focused and long-term investors, which dampens volatility. Another factor is margin of safety. Value stocks are usually purchased at lower valuations, providing some buffer against negative surprises. Growth stocks, by contrast, are often priced for perfection. Small disappointments can trigger large repricing. This asymmetry contributes to the violent reaction seen in growth stocks. Over time, these dynamics create cycles. During periods of low interest rates and strong optimism, growth stocks tend to outperform dramatically. During periods of rising rates, tightening liquidity, or economic uncertainty, growth stocks often underperform while value stocks hold up better. Neither style is inherently superior. They simply respond differently to changing conditions. In summary, growth stocks react more violently than value stocks because their valuations depend heavily on future expectations, discount rates, liquidity, and investor sentiment. Value stocks are anchored by present cash flows and lower valuations, making them more resilient to shifts in the environment. Understanding this difference helps investors manage risk and avoid being surprised by sudden market moves. Stock volatility is not random. It reflects how the future is being priced today.